Hi there, welcome to another video from Talk Financials, looking at BAT today, British American Tobacco. I'm Johnny Wraith, and as usual, I'm here with my colleague Ted Wainman, who's going to take us through the accounts of this British multinational, have a look at the share price, have a look at some of the important numbers and statistics behind the scenes, and give us his view on how this company is faring and how we think it might fare over the coming months and years. It's obviously a very interesting company in terms of the products it works with, manufacturers and sells cigarettes, tobacco, other nicotine products. And as you can see from that slide, as of 2019, is the largest tobacco company in the world based on its net sales. Needless to say, around this industry, a great deal has changed over the 100 years, 120 years since it was founded. The much more health conscious times that we're living in have obviously given them incredible challenges. And if you look at their website, it's strewn with references to things like building a better tomorrow and reducing the health impact of their own business, accelerating tobacco harm reduction, things like that. So it gives you an idea of the sort of way they're having to twist themselves around to try and reinvent themselves, essentially, given, as I say, the controversial, should we say, nature of the products that they're involved with. At the same time, of course, they have the day job of running an efficient, profitable company, and that's what Ted's going to take a look at today: the accounts and the way that those important dynamics are evolving. One thing I noticed as a person with a background in macroeconomics and interest rates is that this company has a lot of debt. It's got I think, I'll just to use an apt cliche, on the back of a fag packet, had a look, they've got about, I think, 40 billion pounds of debt, nearly half of that maturing over the next 5 years. And given what's been going on with interest rates and financing costs, that's going to be a significant challenge for them, a significant influence on some of their running costs. So interesting for me too to see the sort of underlying health of this company in that context. So I'll come back and talk a little more about that perhaps later, and some of the more recent developments in the news about this company. But before that, I'm just going to hand over to Ted. Just remember, these are his opinions, our views on how the company's faring and the wider markets. It's not formal investment advice. We're not qualified to give that, just our views and hopefully highlighting some of the important dynamics underlying this business. So on that note, over to you, Ted.
Thanks a lot, Johnny. Nice to see you. Welcome to our viewers. Welcome back to our subscribers. If you are not a subscriber, please do hit the subscribe button and don't forget to like and share. This video is at the request. We had Matthew Hammond who said, can we look at British tobacco? And the answer is yes, Matthew, we can, and we are. So without further ado, let's dive in. Here are their accounts. Now, I have got here the annual reports for 2021. Okay, so this is the latest set of numbers. We are recording this at the beginning of February 2023, so they are out of date. And in the annual report and accounts, you will find lots of information about the company, who they are, as Johnny was said, and a lot of comments about how they're trying to make the world a better place by still selling nicotine products. Okay, I'm not sure whether British American Tobacco is on any ESG investment funds, that or the kind of the ethical and social kind of driven themes that seem to be around today. But we're not really interested in business ethics right now. We are interested in business finance. I'm not saying we're not interested in it. I'm just saying that the focus of this video is to understand the financial numbers that sit behind them. And the numbers, if I can get to them, you've got to kind of scroll all the way down through this annual report, all the way down to page 182. So you can see lots and lots of information about the executives and who they are and what they do, etc., etc. But at page 182, we find the income statement. Now, the question is, Johnny, is it still profitable to invest in tobacco products? And with a top line of 26 billion pounds of sales, they're making a profit for the year of 7 billion pounds. It's a resounding yes, they are. Okay, so these guys are making big profits. Now, interesting enough, they don't give you the kind of the split in terms of the gross profit, but you can work that out. If we just take these two numbers here as the kind of cost of sales, basically, every time you buy well, there's going to be a lot of tax involved in terms of the duty, and this revenue will be stated net of that kind of that additional duty. But even so, they're still making 83% gross margin by my back of an envelope rather than a back of a fag packet calculation. An 83% gross margin, 84% in the previous year, and then they've got the costs of running the business. There's the kind of the other operating costs, etc., etc. A little bit of depreciation going on. This is the kind of the employee benefits. We'll talk about that a little bit later on. 27% bottom line, 25% or 24%, sorry, 25% in the previous year. These guys are very, very profitable, and because they're very profitable, Johnny, they're paying lots of tax, which is nice for the UK government because they need every penny they can get. So not only are they paying cigarettes duty, but they're also paying tax on their ordinary activities. And so for the UK government, especially if this is the biggest company in the world, and obviously some of that tax will be overseas, but these guys will be a big donator or a big beneficiary for the US tax authorities, for the Treasury. So there we go. You mentioned the debt, and we'll look at the debt and interest rates, Johnny, just to look at. So this is what's known as the interest cover, is comparing the interest they're paying with their profit. Now, this company is making 10 billion in profit, and their finance costs are 1.5 billion. Okay, so this means that they are about 7 times covered, which means if interest rates double and double and double again, these guys, it's not a problem for them. Okay, so they are so profitable that the debt that they've got, they can easily afford, and therefore I would expect that when it comes to refinancing that debt, it's not going to be a problem for them. Okay, so this is a very key ratio in terms of being able to assess whether a company can afford its debt. Now, obviously, if you start to kind of ban cigarettes, for example, and you put a line through this, then this number starts to go south. Okay, so as things stand at the moment, they are profitable enough to be able to afford their interest and also to be able to pay an increase in interest. However, you make a very, very good point there. We'll come back to that point a little bit later on. But before we do that, let's go and look at what they're doing with that profit. So here we see that profit is basically about half of it, or just over half of it, is being paid out in the form of dividends. Okay, so if you are an income investor and you like your income, then this might be something to hold in your portfolio. Obviously, if you are happy with the ethics of holding tobacco in your portfolio, then you're going to earn a nice juicy dividend. And this dividend happens pretty much every single year. Look, there it is in the previous year and in the year before that. So these guys have been paying dividends on a pretty regular basis, and those dividends have been going up as well. So let's look at the balance sheet. So on the balance sheet, the biggest number in their non-current assets, so these are the things they need to run the business, is basically the intangible assets. And most of those intangible assets is goodwill and trademarks. Okay, so British American Tobacco is a conglomerate of lots of different brands. We'll have a quick look at note 12 because it is a big number, and if it's a big number, we like to just go and have a look at kind of the underlying information. So here we have on note 12, and we can see, there's a lot of goodwill. There's a little bit of computer software, trademarks, and similar intangibles. Not the brand, because it's not exactly the brand, but you'll notice in the intangibles. So goodwill, what do? They own Rothmans, well known. They own Reynolds in America. etc., etc. So a lot of this is, they've grown by buying tobacco companies, and that gives rise to the goodwill that sits in their balance sheet. So that's the big number making up their sort of their non-current assets. In terms of their current assets, they've got a little bit of their inventory looks pretty high, I have to admit. So don't forget, these guys, they're turning over about 25 billion, and they've got 5 billion of inventory. Now this, I know very little about the tobacco industry, but I guess that you harvest your tobacco and then you have to let it dry, and you have to, so it takes a while for it to to become smokable, so to speak. And I'm guessing that that's why they have a lot of inventory. They've also got some trade and other receivables, doesn't look too bad. And they've also got some cash, 2.8 billion of cash. Okay, so reasonably healthy there. In terms of their liabilities, here is their liabilities. Now, current liabilities down. So you mentioned the borrowings. Let's just talk about the borrowings. So 35 billion of non-current borrowings. That's due next year, the year after that. About 4 billion of current borrowing. So add those two together and you've got up to about 40 billion of debt sitting on this balance sheet, nearly 40 billion of debt, but the interest rate's only about 4%, so it's pretty cheap. And even if it goes up to 5, 6, 7 or 8%, these guys, it's still not a problem for them. They're generating enough profits to be able to afford that debt at the moment. Current liabilities, things we have to pay soon. The other big number is their trade and other payables. Again, that looks pretty high to me, and I'll come back to that figure in a minute. But the current liabilities here, 15 billion, and we like to compare that to their current assets of 13 billion. Now, is that an issue? Do they have liquidity problems? Are they struggling? Maybe these trade and other payables have increased because they don't have enough cash to pay them, or because they have cash flow issues. Do they? Okay. I don't think they do. And the reason I don't think they do is that if we look at the analysis, it takes them a long time to sell their inventory. So my back of an envelope calculation is nearly 470 days, and that's going to be a maturing thing, I think. Okay, so you harvest your tobacco plant, and then you leave it to dry out basically before you sell it. Accounts receivable about 41 days, and I think their accounts payable about 381 days. And I think the reason for that is that these guys, they just use their negotiating muscle. They just say, look, we'll pay you in a year, live with it, and if you don't like that, you can go sing Dixie. So I'm guessing that these guys use their financial power in order to negotiate very, very good supply terms with their trade creditors, with their suppliers. Okay, and that's a pure guess. So if anybody watching has insight on that, how the industry works, then please do let me know. They got some deferred tax liability. That's another big number. I'm sitting in their non-current liabilities, but even so, with all those liabilities on top of the assets, the equity 6.67 billion. So lots and lots of equity, lots of retained earnings, lots of juicy retained earnings sitting in there, funding the business. Okay, so it's a combination of about 26 billion of profit plus another 40 billion of retained earnings, which is effectively driving that equity number. So let's look at cash flow. Here is the cash flow statement, and what we see is that this company is generating lots and lots of cash. So they are generating tons and tons of cash. I really don't see that cash flow is an issue, and I think that because they've got such strong cash flow, that's why their working capital is negative. In my experience, Johnny, companies like supermarkets, which get paid before they pay their suppliers, are generally very, can operate with negative working capital. And I think these guys, because their inventory is so low, they sit on it, and then they sell it at such a high margin, and then they get paid pretty quickly at that high margin, and then they pay their suppliers much later. And I think that's just more negotiating rather than affordability. So looks to me like these guys are, they're in charge. What are they doing in investing? Little bit of investment. I mean, really, if you're generating 9 billion in cash and investing in your capex about 1 billion, and there is a little bit of, buying investments and property, plant and equipment, but, not a huge amount going on, it means that you've got a lot of spare cash. And what are they doing with that spare cash? Well, they are reducing their borrowings. Okay, so often we see the sort of, they're taking out borrowings you know, if you're taking out borrowings like the previous year and repaying borrowings, that's refinancing. This is refinancing, but it looks to me in this particular year, they just said, look, actually, let's just pay down our debt. So they've taken a kind of reduced the debt by 5 billion, and they're paying out a 5 billion dividend. Okay, and that is why they're seeing their cash used in financing of 8.7 billion, and that effectively means that they still keep the same amount of cash sitting on the balance sheet. So the kind of sum total is that they're generating 9 billion in cash, they're spending 1 billion kind of investing in assets, they're spending, you know, 5 billion paying down debt, 5 billion as a dividend, you know, and that effectively kind of, you know, squares the circle, to mix my metaphors. So there's, you know, those are the numbers, and there's, you know, I mean, these guys, you know, very profitable, strong cash flow, which I think allows them to operate at negative working capital. You know, they're ticking a lot of boxes here. So let's go and have a look at the share price and see what the market thinks of these guys. Now, remember, these are, you know, these are the bad boys. You know, this is up there with kind of oil and gas. You know, and if you're an ethical investor, we don't like British American Tobacco. So we're just looking at this from a financial perspective. And if you're looking at this from a financial perspective, you're buying a company on a P ratio of 13.2, which is about 13 times earnings, which is not expensive. It's not crazy cheap, but it's not expensive. What I do find interesting is the market cap. Okay, that's the total value of the company, is about 69, nearly 70 billion. Well, 69 billion is basically the same as the balance sheet. So this is trading at book value, which I found really, really interesting. So P ratio 10 times earnings. The dividend yield is up at about 7%. You know, so very, very nice income. And, you know, I mean, we live in a world of what, you know, interest rate, inflation is running at kind of 10%. So, you know, it's not sort of necessarily holding its own, but, you know, this is a nice way to kind of combat that inflation. I can't see the share price going down much from here. I kind of just feel, you know, we think, you know, I think maybe this performance is over, but it's kind of just taken a bit of a breather. Okay, and now it's starting to kind of, you know, maybe start to tick up a little bit. I think we've got our next slide is a little bit more of an in-depth view. This is 1 year. 1 year is basically just going sideways. It's really not sure what it's doing. It's going up, it's going down, it's going up, it's going down. You know, if you're a day trader, this is your kind of idea of a wet dream, as far as I can make out. Sorry, excuse the language. So, you know, we like volatility, but there's no real direction in there. And I'm not saying it can't go down. And, you know, I guess that kind of leads us through to the Achilles heel. So, you know, in terms of the Achilles, in fact, before we get to the Achilles heel, we've got to talk about the you know, who's in charge and what they're getting paid. So let's have a look at the CEO's remuneration. So CEO is a chap called Jack. We'll find out how much he gets paid on page 139, I think it is. So here we go. So here we see Jack Bowles. So Jack Bowles is paid. I'm just going to use this single number here. There's lots of reasons why I should or shouldn't, but you know, he's basically getting £7.5 million. Which is a nice increase on the previous year, £5 million. That's a 51% pay increase. So well done to Jack, and I'm sure he is worth every penny. How much does that compare to the chaps or the boys and girls in the business? Well, you have to dig around a little bit. So in order to kind of answer that question. So if you want to know how many people work, you've got to go to page 197. Here it is. So in 197, I found out the number of people working. So page 197 tells you how much they're paid. So we're paying our employees 2.7 billion, which is basically the same as the previous year. So there's the pay. And if you want to know how many people are working there, you've actually got to go and dig a little bit further down to page 253. So here we go to 253. Here it is. and we see how many people are actually working. So group employees, and there are 182 or 183,000 people, a little bit down from 89,000. So if you're paying 83,000 people and you're paying them 2.7 billion, you're basically paying an average salary of about £33,000 per year. Now, don't forget, this is a global company, and there will be some people, in poorer parts of the world who are paid substantially less than that, and there'll be some people in the head office in London who are paid substantially more than that. But average is 33,000. And so Jack is on 228 times the average earnings. Okay. The average remuneration last year was about 31,000. So the average pay rise is about 7%. So, just about keeping up with inflation almost. So last year, Jack Bowles paid 161 times the average salary. This year paid 228 times the average salary. So certainly Jack is doing very well with a 51% increase in his pay compared with the average across the board pay rise of 7%. Now, last thing from me, Johnny, and I'm conscious of time and I've been banging on a little bit, so hopefully our viewers have found it interesting. You mentioned this kind of general litigation, and if you dig into the bottom of the accounts, and it's always worth, if you're looking at accounts, looking right at the very bottom, you find these contingent liabilities and financial commitments, and basically they say we are being sued, okay, and we don't know if we're going to win or lose, and we can't put something into the accounts because it's so uncertain. But what they do go on to say is these are all of the cases, so you can see the number of cases that they are being, and there are specific kind of, class actions, it looks like. So you've got 1,200 cases under this kind of Broin 2 case, and you can go and have a look in more detail at note 6, and all the kind of the notes down here will tell you all about, what's going on and who's been, where the status is and who's ruled in which direction, and everyone's appealed. And these guys, they don't settle out of court. They say, if you sue us, we're going to court, we're going to tie you up in lawyers, we got lots of cash, we can drag it out for months and months and years, and unless you're a very big law firm with lots and lots of deep pockets, then really, you're going to be, it's going to be your descendants, your ancestors, your descendants who are going to be benefiting from any payouts. So that's kind of where these guys are, and it's I guess the point is that if you buy this company, you're buying those financial, those contingent liabilities, and we have no idea as to whether these guys are going to pay out tons and tons of money. Don't forget, they're probably insured, and so it's not necessarily these guys who are going to take all of the hit. The insurance company is going to take a lot of the hit. I'm not necessarily that these cases will cause them to go bust, but then maybe they will. Who knows? So there you go, Johnny. That is everything from me. I hope I've managed to shed a little bit of light on British American Tobacco, an interesting company. I just say that if any of our viewers do have any comments, please do be polite. This is no endorsement of the company. It's no comment on the ethics of the company. You may have strong views that financial investing is just that, financial investing, or you may have strong views that investing is on an ethics. Okay, and don't forget, we're not just talking about investing here, we're talking about helping people to learn to read and understand and speak the language of business finance.
Good one, Ted. Very detailed. Just one quick observation from me, if I may, at the end of that. You talked a lot about, as you said, big numbers, very profitable, strong cash flow. I was just sort of looking in the background and discovered that although demand for cigarettes, for example, in the UK has fallen by 2/3 since the 1970s, which tells you the challenges that this company faces in developed markets anyway. They're still expected to sell 500 billion individual cigarettes this year, 500 billion cigarettes. So still huge demand for this product, but those challenges are very real, and it's worth keeping an eye on how they evolve their company, how they change their management structure. They did actually announce yesterday that they were changing the way that they split up the regions globally and reducing the number of business units from 16 to 12 across the company. So they're very actively making sure that they're ahead of the game as demand for their sort of core product over time falls away from extremely high levels for all the obvious reasons. So there we go. I don't have anything else to add, Ted. So unless you do, just to say to anyone, please do like, share, subscribe. Any views you've got, agreeing with Ted, disagreeing with him, please do leave them in the chat below, and hopefully you found that interesting. On that note, thanks very much, and we'll see you next time.
Good to see you, Johnny. Catch you later.
Cheers, mate.
Hello, thank you for watching that video, and I hope you found its contents useful. If you want to know more about what we do here at Talk Financials, you can find out on talkfinancials.com, where we will explain how we design, develop, and deliver training workshops for companies all over the world. We've worked with over 300 companies in over 35 countries around the world, helping them to understand financial statements, to understand business finance, and to become fluent in the language of business finance. If you're interested in developing your own skills in how you read and interpret financial statements, I've developed an online workshop which is available. All you got to do is click on the QR code there, point your camera at the QR code, and that will take you through to an online workshop, and it will help you to improve your own ability to read and interpret financial statements. I've also written a book called How to Talk Finance, and again, that is available. If you click on the QR code, it'll take you through to the Amazon website, where you can buy the book either as a hard copy or as a Kindle edition. And that's really everything from me. I'm on LinkedIn. It'd be great to stay in touch. If you'd like to contact me, then again, just click on the QR code and send me a message. And good luck with your financial analysis. I hope it goes well.